there's a bubble.
How do you know?
Trust me, call Venet, buy 50 million in swaps on the MBS. What do we got?
Michael Burry wasn't the only person in 2007 who figured out that a housing collapse was about to cripple the financial system. Steve Eisman, depicted by Steve Carell in Paramount Pictures' The Big Short, also made an enormous amount of money betting against the banking sector. And today, Eisman was back on CNBC providing a frightening outlook on the unfolding financial crisis that began last week with Silicon Valley Bank. This week, Credit Suisse, an investment bank with over $500 billion of assets, is on the brink of collapse. And while it seems like the bank would be considered too big to fail, what if it's actually too big to save? In this video, I'm going to share some clips from Eisman's latest interview, including his outlook on the US banking system, Credit Suisse, and where to invest given the new economic environment. Also, I'm trying to hit 200,000 subscribers by the end of the year, and if you'd like to help me achieve that, then the best thing you can do is go below this video and hit that subscribe button. So I really appreciate it, but with that said, let's get into the video. Many people are comparing the banking crisis we see today to what happened in 2008. But besides both of them happening within the financial sector, the situations are actually completely different.
You know, as Warren Buffett says, when the tide goes out, you see who's naked. This is a different tide. This is not a credit tide. Credit quality in the United States is really good. This is a tide of a mistake.
The failure of Silicon Valley Bank, Signature Bank, and now potentially Credit Suisse has absolutely nothing to do with the quality of their credit. These banks aren't failing because they thought they had billions of dollars worth of assets that are now worthless, but rather the types of assets they actually chose to invest in.
Some of the regional banks, especially those that have a lot of deposits above 250, bought long-term bonds at very, very low levels and have massive mark-to-market losses. That's why Silicon Valley failed. Also, they failed because they had a very, very concentrated type of deposit base, which has a very big herd mentality.
Silicon Valley Bank chose to invest a large portion of its deposits into long-term treasury bonds when interest rates were very low, which by the way is pretty much fine in any circumstance except one where there is a rapid increase in interest rates, which is of course what has happened over the past 12 months. All of a sudden, these safe-looking US treasury bonds needed to be sold well before maturity at a steep discount. Silicon Valley Bank wasn't included in the banking stress test that occurred last year, but even if they were, it's likely that their problem would have still been missed.
We looked at the stress test for last year, and the stress test for last year had about a line in it about rising rates, and the rest of the entire stress test was about credit. So even if Silicon Valley had been in the stress test, given what the stress test says, I don't think the regulators would have caught it.
So with this new interest rate issue now exposed to the world, is it at all possible that the issues that regional banks are facing could flow into major national banks like Bank of America or JP Morgan? Eisman believes that the large US banks are not in the same position as some of the regional banks, so the risk of bigger banks failing is relatively small. But that doesn't mean that there won't be any more pain in the financial sector before the dust settles.
Number one, the large US banks are better capitalized and have less risk than they ever had in anyone's lifetime. The European banks, while they're not as well capitalized, are certainly better capitalized than they are. That isn't to say there won't be pain if Credit Suisse goes down, but it's not an 08.
As we enter the second week of banking failures, all eyes have now turned to Credit Suisse, a global investment bank based in Switzerland with over $1.5 trillion of assets under management. The bank has been struggling for quite some time now, actually also never recovering fully from the global financial crisis 15 years ago. In the last 12 months, the stock is down over 70%, and the rate of decline accelerated on Wednesday after falling 30% in just a few hours after management said it had found material weakness in its financial reporting.
I mean, people have been pulling back from Credit Suisse from a long time. I mean, if you hear that the company goes bankrupt, there will be losses. It's not death-defying losses, but it'll be a problem. It's not going to take down the system.
It's also the case that typically the bigger the bank when it fails, the more likely it is to receive a government bailout. And that's simply because the government has to decide whether it's worth bailing out the bank to prevent losing widespread consumer confidence in the banking system, which could be much more disastrous than just the isolated incident. But what if Credit Suisse is actually too big to be saved?
In 2008, when everybody was trying to get bailed out, you know, if you looked at the U.S., the size of US GDP was many multiples bigger than all the bank balance sheets combined. We looked at Credit Suisse today. Credit Suisse balance sheet is 500 billion. The GDP of Switzerland is 800 billion. So could Switzerland do something? Yeah, they could do something. It's not going to be easy.
Credit Suisse is such an enormous part of Switzerland's GDP that a complete bailout may actually not be possible. And it's for that exact reason why we're now seeing the Swiss Central Bank step in early to try and prevent something like that playing out. On Thursday, Credit Suisse announced that they're able to now borrow $50 billion from the Swiss Central Bank, stating this additional liquidity would support Credit Suisse's core businesses and clients as Credit Suisse takes the necessary steps to create a simpler and more focused bank built around client needs. So given everything that has happened so far, where does Eisman see the opportunities to invest right now? Just before I share those clips, I want to talk about the sponsor of today's video, Seeking Alpha. Seeking Alpha is a massive online community of stock pickers, and the premium plan has a ton of awesome features for investors. Expert analysis and news for thousands of different stocks to help you learn the ins and outs of what's going on with companies and the economy. You can import and track your own portfolio, including adding buy or sell price alerts. There are consensus buy, hold, and sell ratings from members, Wall Street analysts, and Seeking Alpha's own algorithm. You can screen for stocks using a variety of fundamental and technical analysis metrics, access up to 10 years of financial data and company filings. There's also a ton of educational content to help improve your skills, including webinars, podcasts, and articles. And best of all, if you head down and use my link in the description below, you can sign up to an annual plan for as little as $8 a month. So use the link in the description or head directly to hamishhodder.com/Seeking Alpha and try Seeking Alpha out today.
Let's say the government doesn't bail anybody out. So clearly JP Morgan and Bank of America benefit. And it turned out, even though they did get bailed out, JP Morgan and Bank of America benefited. So our first thought was, well, maybe we should buy JP Morgan and Bank of America.
With this banking crisis being one of interest rate risk rather than of credit quality, there's been a distinct separation of how the banks are being affected. Those smaller regional banks with large amounts of uninsured deposits are at risk of customers panicking and withdrawing their money. Even with the FDIC stepping in and completely covering all deposits at SVB and Signature Bank, it's still entirely possible that we could see customers where most of their funds are not insured panicking and wanting to withdraw their money from these regional banks. On the other hand, large national banks like Bank of America have a much larger percentage of their deposits covered by FDIC insurance, which makes a bank run at these large national banks far less likely. So not only are the big banks not facing the same issues as the regional banks, they're actually benefiting from people moving money out of regional banks where most of the funds are uninsured into banks where most of the funds are insured, or at least a larger percentage are, and that are far less likely to experience a bank run like these smaller banks. So does that make some banks a good place to invest right now?
And then upon further reflection, we were like, maybe not. Because given what's just happened, all the regulations are probably going to get much more stringent, making the banks much less profitable. And that's not going to be clear for many, many months. So why be a hero? Because you have absolutely no idea what's going to happen. The best you can say is you don't know. And if you don't know, you shouldn't play.
Eisman has looked at the banking sector and concludes that he simply doesn't know how profitable the banks are on the other side of this, so he's not investing. This is a simple but a very important principle to understand when you're investing. There are tens of thousands of publicly traded companies, and you don't have to have an opinion on most of them. In fact, you only need to have an opinion on a handful to do extremely well over time. In his latest shareholder letter, Warren Buffett shared that almost all of his investment success had come from about 12 investment decisions, an average of just one great decision every 5 years. So while it's important to always be looking in the markets for unique investing opportunities, if something doesn't make sense to you, just simply avoid it. But what does Eisman see outside of the banking sector?
I think what's happening is we're moving from one paradigm to another paradigm. So the paradigm of the last several years has been rates are very low, you're paid to take risk, and you're actually paid to take a lot of risk. So, what did the best over the last 10 years? High growth tech stocks. What did the worst last year? Super high growth stocks with negative earnings. Now, are people going to go back to that? I don't think so, especially if rates stay up.
Eisman believes that the outperformance of high growth tech isn't likely to return anytime soon. In the ultra low interest rate environment of 2010 to 2020, Investors got paid to take additional risk. But in 2023, with interest rates now close to historical averages, it's far more difficult for unprofitable companies to operate, so the returns in stocks have shifted away from speculative tech into other areas of the capital markets.
So what I think is coming is, number one, I think you're going to have a much more diversified portfolio. You certainly can leave money in your money market fund because it's over 4%. I think over time, you'll be able to buy some treasuries and buy some bonds.
With cash now offering a pretty substantial return for investors, it's a viable place to store some of your capital. And that has drawn a huge amount of money out of the stock market. It also brings back a level of volatility in the stock market that hasn't occurred for a very long time. From 2010 to 2020, because cash and other safe investments offered such bad returns, even when there was some level of uncertainty in the economy, money tended to stay in the stock market, causing there to be less volatility. Today, investors can secure about a 4% return outside of the market, so any fear or uncertainty causes much larger stock price swings. And while for the emotional investor this is a bad thing, for a value investor who is trying to buy a great company when its price is unreasonably low, volatility is exactly what we want. Interestingly, there's also some businesses that Eisman is short selling or betting against, given the rising interest rate environment that we're in.
Office real estate is going to be a problem. Yeah, we do. We think office real estate, but the way these things unfold, it takes a long time. I think what the catalyst will be, it really depends on each company when their debt rolls over. If somebody bought that building 2 years ago with long-term debt at 3%,
right,
and let's say it's 5-year paper, and in 5 years it's going to roll over and it's going to be 7%. That's not good.
What Eisman is talking about is also the situation currently playing out in residential real estate in Australia. You have a huge number of mortgages that will be rolling over from a 2% rate to about a 7% rate. The only difference is that instead of this taking place over the next 5 years, it's happening right now. And it should remind people that we likely haven't seen the full effect of the interest rate increases, and there could still be quite a lot of negative outcomes that we haven't seen yet take place over the next year or so from the delayed effect of those interest rate increases. The Federal Reserve in the US is in a particularly difficult position trying to balance the fight against inflation without crippling the economy, and we will see what the next decision by the Fed is next week.
So either they're going to do 25 basis points or they're going to do nothing. So let's start with the nothing. I got calls for today that, well, because of Credit Suisse, maybe the Fed will do nothing, and that's really positive. And my response was, really? You're rooting for a financial crisis so that the Fed won't raise rates? I mean, if the Fed doesn't raise rates, maybe it'll be positive for a couple hours or a couple of weeks, but the Fed won't be raising rates because it's scared. Well, if the Fed is scared, you should be scared. On the other hand, if the Fed raises rates even in the face of this by 25 basis points and says that we still could raise more, then that's like, wait a minute, you're sort of caught between a rock and a hard place. Financial conditions have really tightened, but you still have inflation. It's not clear either move is good.